Please welcome David Vogelstein.
Thank you, Madam Toastmaster, fellow members. The topic I would like to speak to you about today may not be the most exciting topic. However, it may just be the most important financial decision you make for your family. The topic I want to talk about is life insurance. To be more particular, I'd like to talk about cash value life insurance versus term insurance. And the first thing I'd like to do is define some terms. And the first term is, what exactly is life insurance? Well, life insurance is basically just a form of risk management. And when you're thinking about getting a life insurance policy, the two risks that you really want to worry about managing is the risk of either dying too soon or living too long. As simple as that. For the risk of dying too soon, you may want to think to yourself, if I'm not around anymore, how is my family going to replace the income that they're relying on? And if you're thinking about the risk of living too long, you might want to think, I'm going to want to retire one of these days. I'm not going to want to work all my whole life. So I'm going to need some type of savings account or investment vehicle to support me through my later years. So life insurance policies, there's really only two forms of life insurance policies. There's the cash value life insurance policies, which some people call permanent life insurance policies, or there's term life insurance policies. Now, cash value comes in many different flavors. There's whole life, universal life, variable universal, etc. But the main basic characteristic of cash value life insurance policy is that it has some form of savings account or some cash accumulation associated with that account or with that policy. Now, with term insurance, most experts call that just pure life insurance. You buy a life insurance policy for a certain term or period of time, and if you were to die during that period of time, your beneficiaries would get the death benefit. If you didn't die within that time period, your beneficiaries don't get anything out of it. So it's basically use it or lose it type of policy. And now that I've defined a couple of the terms I'm going to be speaking about later, I want to share a story with you. It's about two men named Slim and Tim. They're both 30 years old, and they have the same financial resources. And for life insurance purposes, they are at the same level of insurability, because I want to compare apples with apples. And you can follow along with the handout that I passed out. There's some extra ones on the table. So first of all, Slim decides to get a cash value life insurance policy to protect the $50,000 worth of income that he and his family rely upon. So he decides to get a $500,000 policy. He figures that if his beneficiaries were to invest this money, he could, working at 10%, that will pump out $50,000 a year, thus replacing his lost income. So a cash value life insurance policy of this size is going to cost you around $350 a month. And if Slim were to keep paying that $350 a month for 35 years, until he's 65, the cash accumulation in that policy will get up to $300,000. So you can see that Slim meets both risks, the risk of dying too soon with the $500,000 life insurance policy, and the risk of living too long with a $300,000 cash accumulation. So now let's check out and see what Tim did. Well, Tim decided for the same exact reasons as Slim to get a $500,000 life insurance policy. However, he decides to get a term life insurance policy. Now, term being a lot cheaper only costs Tim $62 a month. So the only difference is that there's going to be no cash accumulation with this term policy. So it kind of looks like Tim only is mitigating the risk of dying too soon with the $500,000 death benefit, and he's not mitigating the expense for living too long. Or is he? If you turn over the page to the back, if Tim were, I mentioned earlier that Tim and Slim both have the same financial resources. So they were Tim was still able to afford the $350 that Slim paid for his policy. So let's just assume that Tim pays the $350 a month. But Tim's going to keep paying the $62 a month on his term insurance, and he's going to take that extra $288, the difference between the cash value and the term, and invest that. And if you look down at the bottom of the back page, there are actual numbers of what would happen if you were to invest $288 a month for 35 years. If you at 6%, you can see that even at 6%, that beats Slim's $300,000. And look, when it gets to 10%, you're into the millions, $1.1 million. And then at 12%, $1.8 million. So you can see that Tim can actually mitigate his risk of both dying too soon and living too long with this term life insurance. In conclusion, I can't think of a better way for a family to create a risk management plan for themselves than to buy the cheaper term life insurance and invest the difference. Now, the traditional life insurance industry will have you believe that you need to have life insurance throughout your whole entire life. But most reputable consumers will beg to differ with that comment. People like Dave Ramsey, Susie Orsman, Gene Chatsky, to name a few, they would tell you that the cash value concept is even a flawed concept. Because the thing that you want to do is you want to minimize what you spend for the risk of dying too soon, and you want to maximize what you pay for the risk of living too long. Because chances are, there's a better chance that you're going to live too long than die too soon. And any dollar spent towards dying too soon is not going to be able to be spent towards living too long. So thank you all. Madam President.